General banking terms. Bank, a financial institution that accepts deposits and provides loans. Federal Reserve, Fed, the central bank of the U.S., which regulates monetary policy. FDIC, Federal Deposit Insurance Corporation, insures bank deposits up to a certain limit. Credit union, a member-owned financial institution offering banking services. Community bank, a small, locally operated bank. Commercial bank, a bank that provides services to businesses and individuals. Investment bank, a bank that deals with securities, mergers, and capital markets. Savings and Loan Association, S&L, a financial institution specializing in savings accounts and mortgage loans. Shadow banking, non-bank financial intermediaries providing credit services, accounts and deposits. Checking account, a deposit account for frequent transactions. Savings account, a deposit account that earns interest. Certificate of deposit, CD, a time deposit with fixed interest. Money market account, a deposit account with higher interest. Unlimited transactions, overdraft, spending more than the available balance in account. Direct deposit, electronically depositing funds into an account. Wire transfer, electronic funds transfer between banks. Loans and credit. Mortgage, a loan for purchasing real estate. Home equity loan, a loan based on home value minus outstanding mortgage. Personal loan, an unsecured loan for various personal expenses. Auto loan, a loan for purchasing a vehicle. Credit score, A, numerical rating of creditworthiness. Credit card, a revolving credit line for purchases. APR, annual percentage rate, the yearly interest rate on a loan or credit card. Subprime loan, A, high interest loan for borrowers with poor credit. Debt to income ratio, DTI, a measure of a borrower's ability to repay debt. Underwriting, the process of evaluating a borrower's risk. Regulations and compliance. Dodd-Frank Act, a law regulating financial markets, POST 2008. Crisis. Glass-Steagall Act, a former law separating commercial and investment banking. Bank Secrecy Act, BSA, requires banks to report large transactions. Anti-money laundering, AML. Regulations to prevent illegal financial activities. Know your customer, KYC, rules requiring banks to verify customer identities. Basel III International Banking Regulations on capital requirements. Payments and transfers. ACH, Automated Clearinghouse, a network for electronic payments. SWIFT, an international payment messaging system. RTGS, real-time gross settlement, a system for instant fund transfers. Clearinghouse, an intermediary for processing payments. Mobile payments made via smartphones, e.g., Apple Pay. EFT, electronic funds transfer. Digital movement of funds. Interest rates and money supply. Prime rate, the interest rate banks charge their best customers. Discount rate, the Fed's interest rate for banks borrowing money. LIBOR, London Interbank Offered Rate, a former benchmark interest rate. SOFR, secured overnight financing rate, replace LIBOR for U.S. loans. Inflation, the rise in prices, reducing purchasing power. Deflation, a decrease in the general price level. Monetary policy, the Fed's actions to control money supply and interest rates. Banking risks and crises. Bank run a large number of withdrawals due to fear of bank failure. Systemic risk, the risk of financial system collapse. Bailout, government financial assistance to struggling institutions. Too big to fail, the idea that some banks are essential to economic stability. moral hazard risk-taking behavior due to safety nets like bailouts. Banking institutions and market participants. Central bank, the authority that controls monetary policy and currency issuance. Retail bank, a bank that provides financial services to individuals. Wholesale bank, a bank that deals with large corporations and financial institutions. Correspondent bank, a bank that provides services to another bank. Clearing bank, a bank that clears checks and payments between banks. De novo bank, a newly established bank. Thrift bank, a financial institution focusing on savings and home loans. Banking products and services. Demand deposit funds available for immediate withdrawal, e.g., checking accounts. Time deposit, a deposit held for a fixed term, e.g., CDs. Escrow account, a third party account holding funds until conditions are met. Remittance, money sent from one country to another. Cashier's check, a bank guaranteed check. Traveler's check, a prepaid check used for travel. Safety deposit box, a secure storage space in a bank. Bank draft, a check drawn on a bank's funds. Standby letter of credit, SBLC. A bank guarantee ensuring payment in case of default. Line of credit, a flexible loan allowing borrowing up to a limit. Bridge loan, a short-term loan used until permanent financing is secured. Lending and debt instruments. Secured loan, a loan backed by collateral. Unsecured loan, a loan without collateral, based on creditworthiness. Adjustable rate mortgage, ARM, a mortgage with interest rates that change periodically. Fixed rate mortgage, a mortgage with a constant interest rate. Balloon payment, a large final loan payment. Syndicated loan, a loan provided by multiple lenders. Leverage borrowing, to invest, amplifying gains or losses. Foreclosure, the legal process of seizing property for unpaid loans. Refinancing, replacing an existing loan with a new one, usually at better terms. Debt consolidation, combining multiple debts into one for easier management. Regulatory bodies and acts. OCC, Office of the Comptroller of the Currency, regulates national banks. SEC, Securities and Exchange Commission, regulates financial markets. CFPB, Consumer Financial Protection Bureau, protects consumers in financial transactions. FINRA, Financial Industry Regulatory Authority, oversees brokers and securities firms. Truth in Lending Act, Taylor, requires lenders to disclose loan costs. Fair Credit Reporting Act, FCRA, regulates credit information sharing. Equal Credit Opportunity Act, ECOA, prohibits discrimination in lending. Community Reinvestment Act, CRA, encourages banks to serve low-income communities. USA Patriot Act includes anti-money laundering, AML, provisions for banks, banking operations and services. Interbank lending, short-term loans between banks to maintain liquidity. Settlement, the finalization of a financial transaction. Bank holding company, a company that owns or controls one or more banks. Merchant bank, a bank that provides financing and advisory services to businesses. Offshore banking services provided outside a depositor's home country. Correspondent account, account used by one bank to handle transactions for another. Securitization, converting loans into tradable securities. Stress testing, simulating extreme conditions to assess a bank's stability. Bank charter, a legal document granting the right to operate a bank. Deposit insurance, protection for depositors in case of bank failure. Types of bank accounts and investment products. Sweep account, an account that automatically moves excess funds into an investment. Joint account, a bank account owned by multiple individuals. Custodial account, an account managed by one person for another, usually a minor. Trust account, a financial account held by a trustee for a beneficiary. IRA, individual retirement account, a tax-advantaged retirement savings account. Roth IRA, a retirement account where contributions are taxed, but withdrawals are tax-free. 401k plan, an employer-sponsored retirement savings plan. 529 plan, a tax-advantaged savings plan for education expenses. Fraud and security in banking. Phishing, fraudulent attempts to obtain sensitive information. Identity theft, stealing personal information to access financial accounts. Skimming, illegally capturing card information using a hidden device. Check kiting, writing a check from one account and covering it with another without funds. Forgery, falsifying financial documents or signatures. Ponzi scheme, a fraudulent investment scheme promising high returns. Wire fraud, fraudulent use of electronic communication to deceive financial institutions. Money laundering, concealing the origins of illegally obtained money. Cybersecurity, risk, the threat of digital attacks on banking systems. Banking technology and digital finance. Core banking system, the back-end infrastructure handling banking transactions. Fintech, financial technology, technology-driven banking and financial services. Neobank, a digital-only bank without physical branches. Blockchain, a decentralized ledger system for secure transactions. Cryptocurrency, digital or virtual currency secured by cryptography. Stablecoin, a cryptocurrency pegged to a stable asset like the US dollar. Smart contracts, self-executing contracts with terms written into code. Digital wallet, a software-based system storing payment information. Tokenized payments, secure payments using encrypted digital tokens. Interest rate and monetary policies. Negative interest rate, a scenario where depositors pay to hold money in banks. Yield spread, the difference between interest rates on different debt instruments. Federal Open Market Committee, FOMC, a branch of the Federal Reserve that sets monetary policy. Open market operations, OMO, buying and selling government securities to control money supply. Quantitative easing, QE, a central bank policy of purchasing securities to inject liquidity. Tapering, gradual reduction of central bank asset purchases. Inflation targeting, a monetary policy aimed at maintaining inflation at a set level. Stagflation, a combination of high inflation and stagnant economic growth. Interest rate risk, the risk of loss due to fluctuating interest rates. Financial markets and instruments. Treasury bill, T-bill, a short-term U.S. government debt security. Treasury bond, T-bond, a long-term government debt security. Treasury note, T-note, a medium-term government security with fixed interest. Municipal bond, a bond issued by local governments to fund public projects. Corporate bond, a debt security issued by a company to raise capital. Commercial paper, a short-term debt instrument issued by corporations. Repo, repurchase agreement, a short-term borrowing arrangement using securities as collateral. Derivatives, financial contracts whose value is based on an underlying asset. Credit default swap, CDS, a financial contract for transferring credit risk. Financial ratios and performance metrics. Return on assets, ROA, a measure of profitability relative to total assets. Return on equity, ROE, a measure of profitability relative to shareholders. Equity. Liquidity ratio, a measure of a bank's ability to meet short-term obligations. Efficiency ratio, a metric comparing a bank's expenses to its revenue. Debt service coverage ratio, DSCR, the ability to cover debt payments with earnings. Non-performing loan, NPL, a loan where the borrower has missed multiple payments. Provision for loan losses, funds set aside to cover potential bad debts, banking crisis and economic risks. Currency crisis, a sharp depreciation in a nation's currency. Hyperinflation, extremely rapid inflation reducing currency value. Twin deficits, a situation where a country has both a fiscal deficit and a trade deficit. Deposit flight, large-scale withdrawals due to fear of bank instability. Moral suasion, persuasion by a central bank to influence banking behavior. Capital flight, large-scale movement of money out of a country due to economic instability. Contagion, the spread of financial crisis from one institution or country to another. Bank resolution, the process of handling a failing bank without severe economic disruption. Types of banks and financial institutions. Universal bank, a bank offering both commercial and investment services. Islamic bank, a bank that operates under Sharia, Islamic law, principles, prohibiting interest. Development bank, a bank focused on economic development projects. Microfinance institution, MFI, a financial institution that provides small loans to low-income individuals. Exim Bank, Export-Import Bank, a government agency supporting trade financing. Private bank, a bank that provides exclusive financial services to high net worth individuals. Challenger Bank, a small, digital-first bank competing with traditional banks. Banking transactions and operations. Overnight lending, short-term lending between banks. Typically overnight. Interchange fee, a fee paid between banks for processing card transactions. Settlement risk, the risk that a transaction does not settle as expected. Float, the time between when a check is written and when funds are withdrawn. Hard inquiry, a credit check that affects a credit score. Soft inquiry, a credit check that does not affect a credit score. Dormant account, a bank account with no activity for a long period. Stale check, a check that is too old to be cashed, typically over 6 months. Payee, the person or entity receiving a payment. Draw, the person who writes a check. Drawee, the bank or institution upon which a check is drawn. Endorsement, signing the back of a check to authorize its transfer. Stop payment order, a request to cancel a check before it is processed. Chargeback, a reversal of a card transaction due to dispute or fraud. Lockbox service, a banking service where payments are sent to a special address for quicker processing. Zero balance account, ZBA, an account that maintains a balance of zero and transfers funds as needed. Credit and lending terminology. Revolving credit, a type of credit that can be used repeatedly, e.g., credit cards. Installment credit, a loan repaid in fixed payments over time, e.g., car loan. Loan to value ratio, LTV, a ratio comparing a loan amount to the asset's value. Origination fee, a fee charged by a lender for processing a new loan. Collateralized loan, a loan secured by an asset as collateral. Uncollateralized loan, a loan given without requiring collateral. Balloon loan, a loan with small payments initially, followed by a large final payment. Covenant, a condition in a loan agreement requiring specific borrower actions. Cross-default clause, a provision where defaulting on one loan triggers default on others. Bridge financing, temporary funding used until permanent financing is secured. Banking, regulations and compliance. Tier 1 capital, a bank's core capital, including equity and disclosed reserves. Tier 2 capital, a bank's supplementary capital, including subordinated debt. Liquidity. Coverage ratio, LCR, a rule requiring banks to hold enough liquid assets for stress scenarios. Net stable funding ratio, NSFR, a requirement ensuring banks have stable funding for long-term obligations. Risk-weighted assets, RWA, a bank's assets weighted by risk for regulatory purposes. Capital adequacy ratio, CAR, a measure of a bank's capital in relation to risk-weighted assets. Prompt corrective action, PCA, a framework requiring banks to take action if their capital falls below regulatory requirements. Volcker rule, a regulation restricting banks from engaging in speculative trading. Garnishment, a legal order requiring banks to withhold funds from an account to pay debts. Stress test, a scenario analysis assessing a bank's resilience to financial shocks, fraud, risk, and security in banking. Kiting, illegally using checks to create artificial balances. Bust out fraud, a scheme where a borrower maxes out credit and disappears. Synthetic identity fraud, a fraud where fake identities are used to open accounts. Friendly fraud, a type of fraud where a legitimate customer disputes a transaction falsely. Transaction monitoring, the process of tracking banking activity for suspicious transactions. Internal controls, procedures to prevent fraud and ensure regulatory compliance. Card not present, CNP. Fraud involving transactions where the physical card is not used, e.g., online fraud. Investment and financial markets in banking. Repo rate, the interest rate at which banks borrow from the central bank using securities as collateral. Hedging, a financial strategy to reduce risk in investments. Yield curve, a graph showing interest rates of bonds with different maturities. Asset securitization, the process of pooling financial assets to create securities. Mortgage-backed security, MBS, a security backed by mortgage. Loans. Asset-backed security, ABS, a financial security backed by non-mortgage assets, like credit card debt. Collateralized debt obligation, CDO, a complex financial product bundling debt instruments. Financial engineering, the design of new financial instruments or investment strategies. Global banking and international finance. Correspondent banking, a banking arrangement where one bank provides services to another in a different country. Foreign exchange reserves. Assets held by a central bank in foreign currencies. SWIFT code, a unique bank identifier for international transactions. Eurodollar, US dollars held in foreign banks outside the United States. Foreign exchange market, Forex, a global market for trading currencies. Special drawing rights, SDR, an international reserve asset created by the IMF. Letter of credit, LC, a financial instrument guaranteeing payment in international trade. Trade finance, banking services that facilitate global trade transactions. Bankruptcy and financial distress. Bankruptcy Chapter 7A. Liquidation process where assets are sold to repay debts. Bankruptcy Chapter 11A. Reorganization process for businesses to continue operations while restructuring debt. Bankruptcy Chapter 13A. Personal debt repayment plan approved by a court. Workout agreement, a negotiated debt restructuring between a lender and borrower. Receivership, a legal process where a court appoints a Receiver to manage a troubled bank or company. Emerging trends in banking. Central bank digital currency, CBDC, a digital currency issued by a central bank. Buy now, pay later, BNPL, a short-term financing option for retail purchases. DeFi, decentralized finance, a financial ecosystem using blockchain to eliminate intermediaries. RegTech, regulatory technology, the use of technology to streamline compliance and regulatory processes. Green banking, banking practices focused on environmental sustainability. Social impact banking, banking that prioritizes ethical and community-focused lending. Embedded finance, financial services integrated into non-banking apps, e.g., payments within e-commerce platforms. Banking industry secrets. Banks make most of their profit from fees and interest, not just loans. Your deposits allow banks to lend far more than they actually hold, thanks to fractional reserve banking. Banks legally and own and your money once you deposit it. You're just a creditor to them. During financial crises, banks can limit withdrawals or freeze accounts. The FDIC insurance limit is $250,000 per depositor, per bank, but not per account type. Credit unions often have lower fees and better rates than banks. Banks can sell your personal data, including spending habits, to third parties. Some banks manipulate credit scores by reporting balances at a strategic time. Many banks invest your deposits in risky assets, including derivatives. Banks lobby hard to influence regulations that protect their profits. Credit card secrets. You can negotiate your credit card interest rate. Many people don't know this. Minimum payments are designed to keep you in debt for decades. A and 0% interest and offer often has deferred interest, meaning you'll owe back interest if you miss a payment. Your credit limit affects your score. Keeping utilization below 30% is ideal. Most rewards credit cards have high interest rates, making rewards worthless if you carry a balance. Banks track what you buy and may lower your credit limit based on your spending habits. Banks target high-income customers for premium cards because they generate more swipe fees. Store credit cards have some of the highest interest rates, often 25% or more. Cash advances have no grace period. Interest starts accruing immediately. Credit cards with annual fees often waive the fee if you ask. Savings and checking account secrets. Banks make money when you overdraft, and they sometimes rearrange transactions to maximize fees. Some banks will close your account if you frequently dispute charges. The best interest rates are usually not at big banks but at online banks or credit unions. Many banks charge an inactivity fees and if you don't use your account for a while. And high yield and savings accounts are not truly high yield. Inflation often negates their returns. Online banks offer better rates because they have lower overhead costs. Banks may lower your interest rate over time without notifying you. If a bank fails, it could take weeks to access your insured deposits through the FDIC. Some banks still charge for paper statements, making digital statements the smarter choice. Banks make money from your unused gift cards. Billions go unredeemed every year. Mortgage and loan secrets. The APR, annual percentage rate, is often more important than the interest rate. Banks sometimes charge an junk fees and like processing fees, that can be negotiated. Your mortgage can be sold to another lender without your consent. Prepayment penalties may apply if you pay off your mortgage early. Banks prefer longer loans because they make more money from interest. Bi-weekly payments can save you thousands by reducing interest. Mortgage approval algorithms sometimes favor those with more debt, too. Collect interest. Private mortgage insurance, PMI, is required if you put less than 20% down but can be removed once you hit 20% equity. Many lenders will waive PMI early if you request a new appraisal. Your credit score affects mortgage insurance costs, not just interest rates. Investment banking and wealth management. Banks often push mutual funds with high fees instead of better, lower cost options. Many bank advisors are not fiduciaries, meaning they don't have to act in your best interest. Banks encourage stock trading because they make money on every transaction. Some banks delay your trade execution to maximize their profits. Many banks invest in hedge funds and other high-risk assets behind the scenes. Banks can lend out the stocks you own for short selling. Savings accounts lose money to inflation, making investing a better option. The financial system depends on people not knowing these tricks. Diversification is key. Never keep all your money in one bank. Index funds outperform most actively managed mutual funds over time. Banking security secrets. Bank fraud protection isn't as strong as you think. Zelle and Venmo scams are often not refunded. Banks sell your location data if you opt into certain apps. Not all banks encrypt customer data the same way. ATM skimmers are still common, even at big banks. Some banks allow account takeovers with just your email and birth date. Two-factor authentication, 2FA, is critical for banking security. If you call customer service, your voice may be recorded for AI verification. And quote, banking holidays and quote, mean your money may be inaccessible for several days. Wire transfers cannot be reversed, making them popular for fraud. If a bank suspects fraud, they can freeze your entire account, even for minor issues. Banking tricks and loopholes. Opening multiple accounts at different banks maximizes sign-up bonuses. Credit unions offer better auto loan rates than dealerships or big banks. Banks use psychological tricks to get customers to sign up for unnecessary services. The best CD certificate of deposit rates are usually not at your local bank. And quote, free checking and quote, often has hidden requirements, like maintaining a minimum balance. If you threaten to close an account, banks often offer retention deals. You can dispute legitimate charges and sometimes get a refund. High-frequency trading firms pay banks for early access to market data. Banks create artificial urgency to push financial products. Your mortgage escrow account often holds more money than necessary, benefiting the bank. Hidden fees and profit strategies. Banks make billions from foreign transaction fees, even when the currency doesn't change. ATM fees can be as high as $7 per transaction in some places. Overdraft fees are structured to trap people in a cycle of debt. Banks sometimes process larger transactions first to increase the chance of overdrafts. Some banks charge and quote, dormant account fee and quote, if you don't use an account for too long. Wire transfers cost banks pennies but are often charged at $25 to $50 per transaction. If you use a non-network ATM, you might pay two fees, one from your bank and one from the ATM owner. Some banks delay mobile check deposits to encourage you to use fee-based services. The fine print often allows banks to change terms at any time. Banks delay refunding fraudulent charges to keep earning interest on the money. More mortgage and loan secrets. Many mortgage lenders sell your loan within months of issuing it. Some banks offer better rates to new customers than to loyal ones. A high credit score doesn't always mean you'll get the best mortgage. Rates, income matters too. Adjustable rate mortgages, ARMs, can increase dramatically after their introductory period. If you make one extra mortgage payment per year, you can shave years off your loan. Interest rates fluctuate daily. Locking in a rate can save you thousands. Some lenders offer lower mortgage rates if you auto-pay from their bank account. Banks often round up when calculating mortgage interest, costing you extra over time. Private lenders can offer better loan terms than banks, especially for small business loans. Banks sometimes refuse to lend in certain neighborhoods, a practice called redlining. More credit card tricks. Some banks offer temporary credit limit increases if you ask. Closing an old credit card can hurt your score by reducing your average account age. Some premium credit cards waive foreign transaction fees, saving you money while traveling. Credit card interest is compounded daily, making balances grow faster. Some banks quietly change the due date of credit card payments to catch people off guard. If you request a credit increase, banks might do a hard inquiry, which can hurt your credit score. No interest financing deals often have hidden fees and penalties. Credit card companies track your spending habits and may adjust your limit accordingly. Many store credit cards only work at one retailer, limiting their usefulness. Some credit cards offer hidden perks, like price protection and purchase security. Business and commercial banking secrets. Banks prioritize big corporate clients over small businesses. Business accounts often have more hidden fees than personal accounts. Some banks require minimum monthly balances for business accounts to avoid fees. Banks often push business credit cards that have high fees and interest rates. Business loans can have variable rates, making payments unpredictable. If a business defaults on a loan, owners may still be personally liable. Banks make extra money by charging businesses higher transaction fees for credit card payments. Some banks provide better loan terms if you use their merchant services. Business bank accounts aren't always FDIC insured beyond certain limits. If your business account gets flagged for suspicious activity, your funds can be frozen indefinitely. Economic and banking system secrets. The US dollar is not backed by gold, it's a fiat currency, meaning it has value because people trust it. The Federal Reserve is not a government agency, it's a private institution. Banks create money out of thin air through fractional reserve banking. Many banks hold derivatives worth more than their total deposits. A bank run can still happen if people lose confidence in a bank's stability. The FDIC doesn't have enough cash to cover all deposits in a massive crisis. During a financial meltdown, banks can be bailed out with taxpayer money. Central banks control inflation by adjusting interest rates, impacting loan costs. Some banks lend money to hedge funds with very little collateral, creating risks. Many large banks engage in off-balance sheet transactions to hide financial risks. How banks profit off you. Banks track your direct deposits to market financial products to you. They create new account fees just to increase revenue, not because of costs. Most financial advisors at banks earn commissions on the products they sell you. Banks want you to carry a credit card balance, it's how they make money. Most people never read the terms and conditions of their bank accounts. Some banks let negative balances build up to increase overdraft fees. Banks often don't tell you about better account options with lower fees. Your debit card number can be stolen even if you never lose the card. If you deposit a large check, banks may hold it for days before clearing it. Some banks charge a fee just for closing an account. More banking security risks. Phishing scams often target bank customers, even through fake bank emails. Some bank employees steal customer information and sell it. Bank tellers can access your entire financial history when you visit. Certain banking apps track your location, even when you're not using them. Hackers can clone ATM cards with skimming devices. Many fraud claims are denied initially, forcing customers to appeal. Scammers can spoof bank phone numbers to steal your information. If your bank account is hacked, you may never get your money back. Some banks delay fraud investigations to avoid issuing refunds. Customer service outsourcing means your data may be handled overseas. Hidden perks and loopholes. Some credit unions offer free coin counting, while banks often charge for it. You can sometimes bypass wire fees by using a linked brokerage account. Banks occasionally offer secret promotions if you ask. Small banks and credit unions often offer lower interest rates on loans. Banks reward big depositors with hidden perks. Pre-approvals don't guarantee loan approval. Banks still do final checks. Some banks refund ATM fees, but you have to ask for it. Banks will sometimes remove a late fee if you call and request it. Some high-yield savings accounts limit withdrawals, catching customers off guard. Employees at some banks get access to VIP investment opportunities not available to customers. More banking industry secrets. Banks deliberately make fine print confusing to discourage customers from understanding terms. Your bank account can be closed without notice if the bank deems your activity suspicious. Some banks profile customers based on transaction history and spending habits. If the economy crashes, banks may restrict access to your funds. Banks hold billions in and abandoned and accounts because people forget to claim them. You can track your own bank's financial health through FDIC reports. Banks lend money at a higher interest rate than they pay on deposits, making huge profits. Some banks have been caught manipulating interest rates, e.g., labor scandal. Digital-only banks often have better perks but less customer service. Some banks use AI to flag transactions, leading to false fraud alerts. Advanced credit card secrets. A high credit score doesn't always mean you'll get approved. Income matters. 2. Some banks reduce credit limits without warning if they think you might default. Credit card fraud is more common than debit card fraud due to online purchases. Using a credit card for everything and paying it off boosts your score. Banks make money when you only pay the minimum balance. It's part of their strategy. If you threaten to cancel a credit card, some banks will offer you a better deal. Banks sell your purchase data to marketers for targeted ads. You can negotiate your credit card fees, especially late fees and annual fees. Having multiple credit cards can actually improve your score, if managed well. Some credit cards lower your rewards rate if you miss a payment. And balance transfer and cards often have hidden fees or deferred interest clauses. Banks have been known to close credit card accounts due to inactivity. A credit inquiry lowers your score, but multiple inquiries in a short time count as one. Some banks track your social media to help determine creditworthiness. Paying off a car loan early can hurt your Credit score. By reducing credit mix. Some premium credit cards offer concierge services that can book hard to get reservations. Business credit cards don't offer the same protections as personal credit cards. Banks time reports to credit bureaus to maximize their own profit potential. Using a secured credit card can help rebuild bad credit. Some banks offer exclusive credit card deals only to private banking clients. More mortgage and loan secrets. Many home buyers don't shop around for the best mortgage rate and overpay. If you pay your mortgage bi-weekly, you make one extra payment a year, saving thousands. Adjustable rate mortgages, ARMs, are often marketed without disclosing the risks. Prepayment penalties still exist on some loans. Even though they're rare, your mortgage lender might not be your mortgage servicer. They often sell the loan. Home equity loans often have variable interest rates, making payments unpredictable. Some lenders won't let you refinance if your credit score drops too much. If a loan has points, it means you're paying fees up front to lower your rate. Paying off high-interest loans first saves more money than paying off small loans. Banks offer better loan terms to customers with multiple accounts. Banking, tech and security secrets. Zelle and Venmo scams are not always refunded by banks. Many banks store your voice print for security without telling you. Online banking apps can track your location even when not in use. If you deposit a check, banks can delay access to your funds for days. Some banks monitor keyboard patterns and typing speed to detect fraud. Banks limit liability for fraud if they believe you were careless. Major banks have been hacked multiple times, but they don't always disclose it. Some bank websites collect more data than necessary about your browsing habits. ATMs can be hacked remotely by cybercriminals. Many banking apps record your screen interactions without your knowledge. Final 10 hidden banking perks. You can sometimes get free safe deposit box access by asking. If you deposit large amounts of cash, banks may report it to the IRS. Banks have VIP services for high net worth customers, but they're not widely advertised. You can negotiate interest rates on personal loans if you have good credit. Some banks offer free international wire transfers, but only to premium customers. If you work at a bank, you may get better mortgage rates as an employee. Perk. Credit unions often offer better car loan rates than dealerships. Many banks waive fees for military members, but you have to ask. Some banks offer free investment advising if you have a high enough balance. You can sometimes get free financial planning by opening a premium checking account. Advanced banking industry secrets. Banks delay check deposits to earn interest on your money before giving you access. Some banks automatically close accounts with zero balance without notifying you. If you deposit over $10,000 in cash, your bank must report it to the IRS. Banks actively sell customer data to third-party advertisers. Some banks freeze accounts for suspicious transactions without notifying customers. Some savings accounts offer teaser interest rates, which drop significantly after a few months. Many banks charge for paper statements, pushing customers toward digital banking. Banks often delay fraud refunds, making customers fight to get their money back. Some banks use deposit holds to encourage customers to apply for overdraft protection. If a bank goes bankrupt, the FDIC only insures up to $250,000 per account type. Banks offer worse interest rates in areas with low financial literacy. If a bank account remains inactive for too long, The state can claim the funds as unclaimed property. Some banks offer better rates to wealthier clients, even for the same loan product. Private banking clients get exclusive investment opportunities not available to regular customers. Many banks don't offer the highest savings rates unless you ask or move money. Banks charge different fees based on location, even within the same company. Some banks outsource customer service overseas, reducing fraud protections. Most banking fees are negotiable if you threaten to leave. Banks often limit transfers between checking and savings accounts to 6 per month. Large cash withdrawals may require advance notice to the bank. Deep credit card industry secrets. Banks design credit card statements to make minimum payments more appealing. If you make multiple payments in a month, you can trick the system into lowering utilization rates. Credit cards can increase your APR if you're just 1 day late on a payment. Some reward points expire without notice unless you keep spending. Credit card companies prioritize higher income customers for exclusive perks. Your credit score drops slightly every time you apply for a new card. Many cashback cards only give the highest rewards in specific spending categories. Some credit cards secretly charge foreign transaction fees, even if advertised as free. Some premium credit cards require you to spend a certain amount to keep benefits. If you're denied for a credit card, you can ask for reconsideration and possibly get approved. Many store credit cards have interest rates above 25%, making them extremely costly. Some credit cards charge interest on purchases immediately if you carry a balance. Banks design introductory 0% APR offers to make customers comfortable carrying debt. If you request a higher credit limit, banks might do a hard pull on your credit report. Paying your bill before the statement closes can improve your credit utilization ratio. Many banks won't tell you that requesting a lower APR is possible if you ask. Some banks limit the number of rewards points you can earn per year. Paying off credit card debt with a personal loan can save money, but may hurt your credit score. Credit card issuers track your payment habits to determine how profitable you are. Some banks adjust credit limits based on your job, industry, and income trends. Mortgage and real estate loan secrets, 401 to 430. Some banks steer customers into higher mortgage rates than they qualify for. Mortgage brokers earn commission from lenders, so they may push pricier loans. Banks often push home equity loans, even when they aren't the best option. Mortgage pre-approvals are not guarantees. Final approvals depend on underwriting. You can request a manual review if you're denied a mortgage. Some lenders charge higher interest rates for self-employed individuals. If you pay your mortgage with a credit card, banks may charge extra fees. Adjustable rate mortgages, ARMs, can double or triple payments after the fixed period ends. Some banks inflate home values during appraisals to approve higher loan amounts. Many first-time homebuyer programs have hidden income restrictions. A mortgage lender can sell your loan multiple times, affecting customer service. Some banks delay reporting missed mortgage payments to help avoid credit damage. Refinancing a mortgage restarts the loan term, even if the rate is lower. Some banks include prepayment penalties to prevent customers from paying loans off early. You can negotiate a lower closing cost with many lenders. The advertised APR doesn't always reflect actual costs, as some fees are hidden. Some banks offer better mortgage rates if you open a high-value deposit account. Banks sometimes limit who they lend to based on zip codes, redlining. If you have strong credit, you can negotiate mortgage lender fees. Some mortgage lenders require private mortgage insurance, PMI, even if you have 20% down. Banking, security and digital risks. If you dispute a charge, banks often side with the merchant first. Some mobile banking apps store unencrypted transaction data, making them vulnerable to hackers. Bank ATMs can store customer transaction logs, making them a hacker target. Banks quietly track your social media activity to assess creditworthiness. Many online banks use AI to flag transactions, leading to false fraud alerts. If you're a victim of fraud, banks may not refund stolen funds. From wire transfers. Most banks have undisclosed spending limits on debit card transactions. Some banks block cryptocurrency purchases using debit or credit cards. Banks use AI-driven behavioral analytics to detect fraud, but sometimes flag legitimate transactions. Many financial institutions have been hacked, but they don't always disclose details. Some banks require two-factor authentication, but still allow password resets via phone. Call centers handling sensitive customer banking info are often outsourced overseas. If your account is hacked, banks may blame you for negligence. Some banks still rely on outdated mainframe systems from the 1970s, making them vulnerable. Wire transfers are the most common target for fraud, but banks take little responsibility. If you deposit a check and it bounces, you may still get charged a fee. Some ATMs steal card information through skimming devices installed by hackers. Your voice print may be stored and used for verification without your consent. Banks have internal watch lists of high-risk customers, even if you haven't committed fraud. Some bank websites auto-save your login credentials, increasing hacking risk.